What if I told you that earning $85,000 a year in Australia doesn't necessarily require working a traditional 9-to-5 job for the rest of your life? Imagine waking up tomorrow morning, reaching for your phone, opening your banking app, and seeing money deposited into your account while you were asleep. No boss. No meetings. No stressful commute through traffic. No clocking in. No asking for vacation days. Just income arriving because of financial decisions you made years earlier. For most Australians, that sounds almost too good to be true. After all, we're taught from a young age that money comes from work. You go to school, get a job, work hard for 40 years, and eventually retire. That's the path most people follow. But what if there was another way? What if instead of spending your entire life working for money, you spent part of your life building assets that eventually worked for you? That's exactly what passive income is all about. Now before we continue, let's be realistic. Nobody becomes financially independent overnight. There's no magic button that suddenly starts paying you $85,000 a year. Building passive income takes time, patience, discipline, and consistency. But once the system is in place, it can completely change the way you think about money, work, and freedom. The first thing we need to understand is how much money is actually required to replace an $85,000 annual income. Most people assume the answer is incredibly complicated, but it's actually based on simple math. If your investments can safely generate enough income to cover your expenses, you no longer depend on a paycheck. That's the goal. Financial independence isn't about becoming a billionaire. It's about reaching the point where your investments pay your bills. One of the first strategies many Australians consider is government bonds. Government bonds are often viewed as one of the safest investments available. When you buy a bond, you're effectively lending money to the Australian government. In exchange, the government agrees to pay you interest over a specified period of time. For conservative investors, this sounds ideal. You know what you're earning, you know when you'll receive payments, and the risk is relatively low compared to many other investments. However, safety comes with a cost. The biggest challenge facing bond investors is inflation. Imagine earning 4% annually on your investments while inflation is running at 3%. Technically you're making money, but in reality your purchasing power is barely increasing. Everything around you continues getting more expensive. Groceries cost more. Electricity costs more. Insurance premiums increase. Housing becomes more expensive. This means your money isn't working nearly as hard as you think. To generate $85,000 annually through bonds alone, you would likely need a portfolio worth several $1 million depending on prevailing interest rates. That's a huge amount of money for most Australians, which is why many investors begin looking at other options. One of the most popular alternatives is dividend investing. When you buy shares in a company, you're becoming a partial owner of that business. If the company performs well and generates profits, it may choose to distribute some of those profits to shareholders in the form of dividends. This creates a powerful concept. Instead of working for income, you own businesses that generate income on your behalf. Australia is particularly attractive for dividend investors because of franking credits. These credits can help reduce tax obligations and increase the overall value of dividend payments received by shareholders. Many Australians build portfolios filled with large established companies such as banks, mining companies, telecommunications businesses, and infrastructure providers. These businesses often pay regular dividends, creating a steady stream of cash flow throughout the year. But there is a catch. Dividends are not guaranteed. A company can reduce its dividend during difficult times. It can pause payments completely. It can even eliminate dividends if conditions become severe enough. That's why diversification is so important. Successful investors don't depend on a single company. They spread risk across many businesses and industries. However, even dividend investing has limitations. This brings us to a strategy that many financial experts prefer: total return investing. Instead of focusing only on income generated by investments, total return investors focus on the overall growth of their portfolio. This includes both investment gains and any income received along the way. This approach is closely connected to something known as the 4% rule. The idea is simple. If you have a large diversified investment portfolio, you may be able to withdraw approximately 4% of its value each year while giving the portfolio a reasonable chance of lasting for decades. Using this rule, generating $85,000 per year would require a portfolio worth roughly $2 million. At first glance, $2 million sounds impossible. Most people immediately stop listening because the number feels too large. But here's where things become interesting. You don't build $2 million overnight. You build it one investment at a time. Imagine investing consistently every month for 20 or 30 years. Add compound growth, reinvested earnings, market appreciation, and time. Suddenly the journey becomes far more realistic than most people expect. Unfortunately, many investors make a critical mistake during this process. They become too aggressive. When people hear stories about massive investment gains, they often assume taking more risk automatically leads to better outcomes. Sometimes it does. Sometimes it doesn't. One of the biggest dangers investors face is something called sequence of returns risk. This risk becomes especially important as you approach retirement. Imagine two investors with identical portfolios. Both average the same long-term returns. However, one investor experiences major market losses during the first few years of retirement, while the other experiences strong gains. Even though their average returns are identical, their outcomes can be dramatically different. That's because early losses combined with ongoing withdrawals can permanently damage a portfolio's ability to recover. This is why managing risk becomes just as important as pursuing growth. Now let's talk about the question everyone wants answered. How do you actually reach a $2 million portfolio? The answer is surprisingly straightforward. Consistent investing. Let's say you invest money every single month. Not occasionally. Not when you feel motivated. Every month. Month after month. Year after year. Decade after decade. The combination of regular contributions and compound growth can create extraordinary results over time. Most people underestimate what they can achieve in 20 or 30 years because they're focused on what can happen in the next 12 months. We live in a world that celebrates instant gratification, but wealth creation rewards patience. This brings us to one of the most overlooked opportunities available to Australians. Superannuation. For many people, super is something they barely think about. Contributions go in automatically and the account sits quietly in the background. But superannuation can be one of the most powerful wealth-building tools available. The tax advantages alone can make an enormous difference over long periods of time. Yet countless Australians never take the time to understand how their super is invested, whether their fees are reasonable, or whether additional contributions could significantly improve their future financial position. Ignoring super can be one of the most expensive mistakes an investor makes. Finally, let's discuss something that almost nobody wants to hear. You may not actually need $85,000 per year. Think about that for a moment. What if the real solution isn't earning more? What if it's needing less? Many Australians discover that small lifestyle changes can dramatically reduce the amount of money required to achieve financial independence. Lower housing costs. Smarter spending habits. Reduced debt. More intentional consumption. These adjustments can have a bigger impact than chasing higher investment returns. If your annual expenses fall from $85,000 to $45,000, your financial target changes dramatically. Suddenly the portfolio required to support your lifestyle becomes much smaller and far more achievable. That's the hidden secret many financially independent people understand. The goal isn't to impress strangers. The goal is freedom. Freedom to choose how you spend your time. Freedom to work because you want to, not because you have to. Freedom to travel, pursue hobbies, spend time with family, and live life on your own terms. The good news is that you don't need to have everything figured out today. You don't need $2 million tomorrow. You don't need the perfect investment strategy. What you do need is a starting point. One decision. One contribution. One step forward. Because the Australians who eventually achieve financial independence aren't necessarily smarter than everyone else. They simply start earlier, stay consistent longer, and allow time to do the heavy lifting.